And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
Can you believe it's Friday afternoon again already?
I know. We blink and bang, we're here.
Here we are again. Luke Smith from Envision Financial, thanks very much for coming in today. You've lined up one of my favourite topics today, exchange-traded funds.
You like these, don't you?
I do. Well, I think they make a lot of sense for a lot of people for a lot of reasons.
Yeah, look, exactly right. Yeah,
Let's talk about some of those reasons.
Look, I think that's a wonderful segue because I often get questions in relation to, well, what are they? How do they work? Are they all the same? Are they new? Are they old? Are they expensive? An ETF is simply an investment product that is created to replicate a part of the market. And I often explain this by saying to older people, because young people don't watch the news anymore, you know, just after the news, before the weather, they go, oh, and the ASX 200 went up 10 points today. So the ASX 200 is an index of companies. And all an ETF does is it replicates that index. Now, that index could be just about anything in any market. So, for example, the ASX 200 is an index. You can buy an ETF that will replicate that. You might want the top 100, the top 50, the top 20. You might want the S&P 500. You might want the NASDAQ, top 100 companies on the NASDAQ, on the tech index. You might want the ASX 300 biggest companies. You know, there are ETFs that replicate that. So an ETF is a passive replication of a particular part of the market. Now, the nice thing about it being passive is they are very, very cost effective when it comes to the investment charges incurred to use them. So if we think about a traditional managed fund and you go to any provider that might have the la-di-da Australian equity fund. Now, that could cost you anything from 0.6% to 1%, maybe more, depending on how they operate. And that will generally replicate the ASX 200 within probably 80 to 85%. And then they'll say, oh, but if you pay us a little bit, like we're going to do this amazing stuff and ooh. Now, if I can buy the ASX 200 biggest companies for 0.07%. There's a significant difference in the investment cost of that opportunity. You can buy the S&P 500 at 0.04%. So an ETF is a wonderful tool to give you a passive exposure to a broad part of a market. And that is wonderful from a risk mitigation perspective. It's wonderful from a diversification perspective. Because what you can start to do is put a few of these things together. And I think a lot of people, by design and really by accident also, make investing a lot harder than it needs to be. Like, you could honestly set up a little portfolio for your kids. You could set up a portfolio outside of super for yourself. You could buy the ASX 300. You could buy the S&P 500, which is the US index. You could buy the NASDAQ, so NDQ is the trading code for the NASDAQ index, 100 biggest companies. You could buy a growth ETF. Now, that would effectively replicate, say, the balanced option in any industry fund, which would run between sort of 70% growth and 30% defensive.
Yeah.
You could buy those four and have 80% of the world covered and then just save into that because they're all internally diversified. So you've mitigated risk. You can be using different issuers. So different companies offer different ETFs in different areas. They don't all have to be from the same provider. And there are a number of very large providers in this market. So Vanguard are in this market, Beta Shares are in this market, BlackRock are in this market. It has grown exponentially in probably the last 10 or 15 years. But I think it's a wonderful way for people to get a really good, broad, diversified portfolio. You can buy them, they're listed. So
This is the big selling point for me. Exchange traded funds.
Yes.
You just buy them on the stock exchange,
Yes.
like any other share.
yeah, so you don't have to fill out a massive application like you do with a managed fund. There isn't a ton of paperwork. You can literally go into your CommSec account or your Beta Shares trading account and say, I want to buy high growth ETF. I want to buy fixed interest ETF. I want to buy the US, technology, semiconductors. There's an ETF in just about any space. Beta Shares would create an ETF with two cockroaches running up a wall if you ask them, right? They are dynamic, they are flexible, and they have evolved the ETF market like no other. You can go on there, you can literally go onto their website, and there are hundreds to choose from in just about any area of investment that you may be interested in.
I had a listener bring up this week talking about ethical investments, and you can get an ETF for that as well. You can
Yep.
you can find an ETF which specialises in companies that operate according to them ethically.
Yep.
And friendly to the environment and respect human rights and all of those things. So you can get an ETF to do almost anything. If you're interested in the space industry, you can get an
Totally.
ETF that will focus on those particular companies.
Yeah, you can buy an ETF that holds semiconductor chip manufacturers.
Yeah.
Great. There's an ETF for anything. You can also have currency hedging in
Yes.
an ETF. So if you buy an offshore index, you may want to consider protecting against an adverse movement in the Australian dollar. So you can buy largest 100 global companies. You can buy largest 100 global companies with currency hedging. So again, part of your broader strategy might be, well, I have half my portfolio hedged, half of my portfolio unhedged. You can do that. You can buy high-yielding Australian equity ETFs where you'll have a high running income stream because they'll harvest dividends out of a particular part of an Aussie market. You can buy an equal weight ETF. So they're generally structured in two ways. One's done on market cap. So the volume of shares, what's the biggest share in the Australian market, right down to number 200, and they're done on a percentage basis. Or you can buy an equal weight ETF where they say, right, in the ASX 200, we're going to give everybody 1.5%.
Yep.
So you're managing your diversification, you're managing your sector exposures, you're also then managing the income stream and dividends and franking credits that you can be entitled to. And people that say, oh, but I don't get the income. Yes, you do. Oh, I don't get the franking credit. Yes, you do. They distribute all of that out to you so that you have all the benefits of holding Australian shares without the need to go and pick this company, that company, or whatever it may be. It's a great way to get a broad exposure, great way to diversify, great way to protect against currency, great way to maintain a well-rounded asset allocation. It's a great way to target fully franked or high-yielding dividends. You can also go the other way and buy high growth, no income. You can buy oil, you can buy currency, you can buy technology. You can buy an ETF in just about anything these days.
It's also a great way to start your investment journey. If you've never
100%.
invested in anything before, ETFs are a fantastic place to start.
Yep.
And you can also make it part of your regular investment plan. So
Yep.
you can set aside a small sum of money every month and just buy more and more units in the ETF every month.
Yep, and this is where I think BetaShares has sort of cornered the market because they have brokerage-free trading accounts where you can buy any of their ETFs and the entire market all through their platform. And you could do exactly that. As a young person, you could go, right, my kids have just got a job, they've joined the workforce, they're getting paid X amount. I'm going to open up a little account. I'll buy the ASX 200, I'll buy S&P 500 and a growth ETF. And of the $100 each week that goes in, we'll go 30, 30, 40. Leave it alone. Let it cook.
Yep.
You've got compounded interest, you've got reinvestment, you've got dividends. It's a great way to get kids involved in doing something. And I think this younger generation now, with all the legislation that's been put forward to make it impossible for young people to buy a house, this is the avenue that I think people need to go down to start building wealth outside of superannuation so you still have access to it. Because anything you can buy in a good super fund, you can buy outside through a Vanguard or a BetaShares or a BlackRock or CommSec or any other provider. Because the underlying investments are exactly the same. It's not that you take on more risk or less risk. If you buy CBA, I buy CBA, and my mum buys CBA, someone else buys CBA, just because it's inside super doesn't mean it's more risky, because CBA is CBA.
Exactly.
So they're a wonderful way for people to become engaged with investing, very, very cost-effective and cheap to run. They're listed so you can get in and out very quickly. They generally have very high levels of liquidity. And they're a wonderful way for people to just put a toe in the market without saying, oh, well, I don't understand analysis. You don't have to. Buy the ASX 200. Buy the S&P 500. Buy the global 100 biggest companies. Buy a growth ETF. Don't make it any harder than you need to. Just start doing something and build them into your super fund. And if your super fund doesn't offer this type of investment, then maybe you're not in a great super fund, because the approved product list of any provider is the gateway to this type of investment. Now, some industry funds say, yeah, you can buy all of those things and this, this, and this. Great. Others go, oh, you can buy those 4 things. Oh, can I buy those? No. And that doesn't mean that fund's bad. It's just that you're trying to find a Ferrari to deliver bread. Or as I say regularly, a Mini won't pull a horse float. Doesn't mean we don't like the Mini. If your super fund doesn't allow you to invest like this, maybe it's not the right fund for you.
Indeed. Luke Smith from Envision Financial is here in the studio today, and we're talking about exchange-traded funds. We'll be back with more in just a moment. Luke Smith from Envision Financial is with me in the studio, and if you could only listen to us during the commercial breaks when we solve all the problems of the world. But today we're talking about exchange-traded funds, and it's time to sum up what we've learned so far. What are the key things we need to remember?
Yeah, so an ETF is a diversified exposure to a basket of assets in a particular area. It's not that they're high risk, no risk, low risk. That has nothing to do with it. I had a lady tell me, I don't want to use those, they're risky. Well, you haven't told me what you're going to buy yet. It's a bit like saying, oh, cars are dangerous. Well, a car doing 180 down the parkway might be, but a car driving at the speed limit's not dangerous. And that's how you need to think of these things. An ETF can be as dangerous and as sexy as you want it to be. It can also be as boring as you want it to be. The reason we want them is that they give us a very cost-effective way to invest, a very good level of diversification. They get very, very specific, and we can target a range of different areas because the market has evolved significantly over the last 10 to 20 years. They are very, very cheap to hold and run. So people out there that don't like spending money, these are right up their alley. They are listed, as we said before the ad break. So you pay brokerage to buy it once, and then you pay the ICR, or the internal cost ratio, for the ability to use that long term. Because if you remember, they are a product. So they need to be run, they need to be administered, they need to be audited, they need to make distribution statements. There's a cost to run these things, but they are very, very lean. And then we mentioned before the ad break, you can buy the ASX 200 index at 0.047%, which is almost free. Like, it's ridiculous. You can target different sectors. You can benefit from income distributions. You can benefit from franking credits. You can benefit from currency hedging. You need to think first, okay, what am I trying to target in my portfolio? Is there an ETF that targets that area? How is my ETF structured? Is it done on market capitalisation? Is it an equal weight? Is there leveraging involved? You can gear these things, or you can internally gear them where, say, for example, for every dollar you invest, they will invest $1.50. Now, they might cost a little bit more to run because there's a lot more admin involved in operating those types of ETFs. But if you don't want to borrow money against a house or in a margin loan, a geared ETF might be a way for you to then be able to get a leveraged exposure to a market that you're comfortable with without incurring a lot more in the way of structure and borrowings and interest and assessments on your salary. So ETFs are a great way to get a simple exposure to any part of the market you wish. They're cheap to run. You get the benefits of the franking credits, the dividends, the growth, the leverage, the currency protection. They are a wonderful, wonderful way for you to put a toe in a market or to invest hundreds of millions of dollars, because it takes a lot of the guesswork out of individual stock picking, which I think if you look at the stats, trying to do that and outperform an index is almost impossible over the longer term.
Yes, even the professionals struggle to do that.
Well, 100%. Like you look at any active fund manager over a 10 or 15 year period, and it's highly unlikely that they can outperform the index. So why not use them to your advantage and diversify your portfolio and maximise the rate of return in your super or your own name?
Indeed. So, Luke, it's time to ask, where can listeners get more information?
Yeah, so office number 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the Strategy Stacker podcast, Luke Talks Money on iTunes. And we have Envision Financial Canberra in the YouTube channel where we've got a back catalogue of all of our shows. So you can watch rather than read. And for the readers, Smart Money Strategy, your ultimate guide to financial planning, with an entire chapter on ETFs, what they are and how to use them.
Sensational. Thanks very much.
See you next week.
See you next week. Luke Smith from Envision Financial, back again at the same time next Friday.